Hello and welcome to Market Domination Overtime. There are quite a few big bullish bets on markets for 2026 on Wall Street, and our next guest says economic tailwinds should support that market sentiment. Here with me at the desk, got Bryant, VanCronkhite, Allspring Global Investments Senior Portfolio Manager. Bryant, always good to see you. Let's start here, Bryant. You say the U.S. economy should be good enough for stocks in early 26. Maybe start there. Why, Bryant? Like, what are the drivers? Is it monetary stimulus, fiscal stimulus? Is it AI capex? What do you see?
Yes, yes, and yes.
Okay.
It's all the above. We have monetary stimulus that's flowing through, and it's going to continue, I think, as the Fed becomes very accommodated over the next several quarters. The fiscal stimulus from the one big beautiful bill is still coming through, and that's going to really help boost up the lower end consumer in a way I think the market's not expecting today. But also, we're going to have this AI capex cycle continue. Not every dollar being spent will be spent well, but it's going to be spent. And it's going to trickle down. It's going to catalyze more phases of the AI build out. That will then drive a replacement cycle that we haven't seen in a long time. So there's a lot of good things happening. We just need to be in the right spot as investors to capture it.
Let me ask you about 2026, and you mentioned it there. You say defined by the next phases of AI. What are those phases, Brian? Explain that to me. And then maybe, are there certain companies that you say, okay, they're well positioned to benefit?
Yeah, the first phase of AI cycle, the build out, was really about a few companies. Nvidia comes to the top of our mind. But as we move forward, I think there's three phases that we're going to begin to see in 2026. The first one is expansion. We need to have more companies participate than just Nvidia and a few companies. That's going to happen. Names like Teradyne. Teradyne does test and packaging for semis. As we build more semis, more complex semis, Teradyne's well positioned to play in that space. After expansion, we go to implementation. How do we take this cognitive world of AI and make it a kinetic world? And we need more devices. We need to go out and replace our laptops, replace our phones. And companies like Keysight will help us with R&D and simulations to build those edge products. And then finally, realization. How do we take what we've now built and realize it both in our lives and in corporate lives? And that's going to help us ultimately get benefits from the AI spend. And we want to be in each of those buckets over the course of 2026 as the phases evolve.
Another trend here I want to get your take on, small caps. You say, Brian, they have staged what you call it's a low quality rally that is now ending. What does quality mean here? How are you defining quality? And then are you suggesting, okay, there's going to be sort of a trade shift there?
Yeah, it's funny, the most overused word in our industry is quality, right? We need to define that. 2025, we had a lot of non-earners, companies that weren't profitable. Their stocks were working incredibly well as investors land grabbed around themes like nuclear module reactors, for example. But that's ultimately going to have to fade away. And what works in small caps over time are companies that have high ROIC, have consistent profitable business models, and those companies were left for dead on a relative basis in 2025. And so the market will eventually go back to trying to grab everything, because they don't know who the winners are, to saying, I actually want to be more discerning. And in small cap, it is paid over the years to be in those higher quality, profitable, high ROIC companies. And today, investors can buy those very, very attractive prices.
Are there any names there, Bryant, you particularly like?
Yeah, it depends on the sector we're talking about there. But as you think about that industrial complex, there's names like a Mueller Industries, a company that is exposed to the build out because they're providing copper and piping into the build out, but they also have an incredible ability to continue to raise prices, take market share, and use their balance sheet to make acquisitions to grow and expand their TAM. That's a business that's done, the stock's done well, but it's grossly mispriced and undervalued in our minds, given where we see the market going in small cap land in the future.
In terms of sectors you like, you highlight materials, you highlight industrials, there are offensive opportunities. You say, how come, Brian? Is that more like, is that cyclical call, or no, those are secular calls?
Well, they're more cyclical, but they also have secular opportunities. So the old economy stocks, some of the materials, some of the industrials, they've been pushed aside for the faster growing tech right now. But as I see the AI capex cycle play out, and I see the economy get the stimulus from fiscal and monetary, we're going to see the transportation stocks, the chemical stocks, all of a sudden become more relevant. You're going to see revenue begin to inflect in a positive way. Margins will expand for the first time in a long time. And investors will say, wow, there's this opportunity still in these old, stodgy, old economy stocks. And so industrial materials are interesting. And I would layer in healthcare. Healthcare, in my mind, has had peak volatility, peak uncertainty, peak regulatory oversight. And as that fades away, there's opportunities in healthcare for those businesses to evolve with the evolving landscape, which includes AI, but also more regulatory certainty. And that category is well priced today for us.
Healthcare name you're partial to?
In the healthcare space, I like the providers and I like the lab companies. So a name like LabCorp, for example. We're going to continuously use more diagnostics, not only for drug development, but for testing for ourselves to make sure that we're diagnosing diseases rapidly and better, but also then using diagnostics and testing to find out which drug will work best for us. Personalized medicine. And the labs, in my mind, LabCorp, Quest Diagnostics, are businesses that have had a long history of sustainable and growing cash flow. Opportunity set for them is so much bigger right now. They're consolidating that fragmented space, so they're going to get volume growth, pricing growth, and consolidation that I think will ultimately show up in the stock price in much higher returns.
Finally, Bryant, I thought this was interesting. You prefer consumer discretionary over staples in 2026, you say. Why? What are you seeing there, Bryant? What's driving that call?
It's a position I haven't had in a long time. I've favored staples and the defensive characteristics for a long time, but as we think about 2026, the consumer has been K-shaped. We've all heard that phrase, and the high-end consumer is doing really well, the lower-end consumer not so well. As I think about the ambitions of the administration, affordability is a big theme right now, and they're going to do everything they can to help that low-end consumer out, whether it's stimulus, whether it's lowering interest rates, and all of that, I think, begins to flow through. And what we're going to see, I think, is the consumer begin to merge. The high-end consumer will keep spending, but the low-end consumer will come up. And right now, areas like the big box retailers, the restaurants, spending has been really slow. Home Depot was telling us, right? Spending has been slow. I believe that begins to evolve in a more positive direction as a lot of focus goes towards the consumer to try to drive spending and drive consumption.
Is there a consumer discretionary name, Bryant, you want to own here?
I actually lean into Home Depot today with the analyst day today, them giving us some guidance on what their expectations are. I think the market's pricing in that lower case scenario, but they told us also what the model should look like as housing recovers. And I think as that plays out, Home Depot today is very, very attractive for us.
Bryant, appreciate your time and all those picks. That was great. Thank you, sir.
Thank you.
Well, President Trump approving the sale of Nvidia's H200 AI chips to China on Monday, but the response from Wall Street muted, and questions still remain about the real demand from China. For more, we're bringing in Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, there's a number of factors going on here at the same time. The first is whether or not these actually end up in China. There's really concern that China may not actually take these chips in as they did with the H20. There's been a lot of discussion as to whether or not that plan to not take in H20s after President Trump had approved them for export was a means for kind of using the U.S. to get at higher end chips. That includes the perhaps H200, the Hopper 200 chips, or even Blackwell chips. We're still not entirely clear on that. President Trump said that President Xi Jinping of China was, upbeat about the conversation with regard to the H200, but that's not exactly them saying, okay, send them on over. The Blackwell chips are obviously the most recent NVIDIA chips, the B300, that's the Blackwell Ultra, then there's the B200, the standard Blackwell. China would be getting the H200, that's based on the older Hopper architecture. It's not just whether or not China would take them or not, it's also, of course, whether the U.S. would block any kind of shipments. There's been members of Congress who have said that, look, this is not safe for us to be providing China with high-end chips like the H200. They could be using them for military purposes, or they could work to supplant the U.S. as far as the AI lead. And then obviously NVIDIA says to that, no, you have to have these kinds of U.S.-made chips in China to ensure that the globe is using U.S. technology. And so they argue that with roughly 50% of AI developers in China, or for the world in China, it only makes sense for them to have access to U.S. technology from NVIDIA and its competitors. So there's a lot going on here. The stock market, I think, response to this has been muted just because this is kind of deja vu. We've seen it happen before where there were plans for chips to be shipped and then they just didn't end up going out the door, or they were pulled back later. So I think it's going to take a while until Wall Street says, okay, yes, this is now once again a reliable source of revenue for the company. It could be a sizable chunk of revenue, but I think it's still too early for them to say, yeah, let's bank on this.
Dan, do we have line of sight into how much better NVIDIA's H200 chips are than what China's local homegrown domestic players are offering right now, or could offer, near intermediate term?
Yeah, I mean, there's been different discussions whether or not it's, twice as better or 4 times better. The H200 is quite an impressive chip, but again, it's 2 generations removed from what NVIDIA currently has on offer. And by the way, they're going to release a new generation in March, presumably at their GTC conference. And so, these chips are certainly more powerful than what Chinese companies have for themselves. Those chips, though, those same chips are more powerful than the H20 that Nvidia is offering. And so, that's part of the reason possibly why China said, look, we don't want these, give us something better. And so with the H200, they would be getting something better. They would be able to, set up new algorithms and run new AI platforms in more efficient ways. But I do think that, the big question is it just about the H200 or is it about the Blackwell chips?
Dan, thank you, sir. Appreciate it. Another big tech story we're watching this week, Oracle earnings. The cloud computing giant expects to release its second fiscal quarter results after the close on Wednesday. And Yahoo Finance tech and markets reporter Laura Bratton joining in now. Laura, what are analysts expecting to hear from this call?
Yeah, so analysts really expect that Oracle's AI cloud business is going to continue driving the business forward. So Oracle Cloud Infrastructure is expected to see revenue climb 68% to just over $4 billion, whereas overall revenue growth is expected to be 15% and come in around $16.2 billion. So really, again, just looking to see what's going to happen in its AI cloud business. And analysts are also going to be watching really closely for commentary on capital expenditures because there's been a lot of focus on how much big tech companies are spending in the AI data center infrastructure space.
Yeah, I mean, that's really, this name got whacked, right? And investors want all this more line of sight into CapEx and then free cash flow implications of this massive AI data center build out. I mean, I get, when you were reading through the notes, did analysts say, listen, they think they'll have that line of sight, like Larry Ellison and Safra Katz, they're gonna provide a lot more color tomorrow on the call, or no, like we'll have to mark our calendars some future date?
Yeah, I think it's something that was missing in their analyst day in October, and it's something that analysts are definitely hoping will be revealed, and they think that it is coming because, Oracle is one of the names or one of the companies that's taken on more debt to fund their AI data center ambitions. And that's something that's had investors more skeptical of the AI trade and, where we are in terms of the life cycle of the bubble. And Oracle has taken on a considerable amount of debt and issued around, nearly $26 billion in corporate bonds this year, and it's on the lower end of the investment grade spectrum. So its bonds have a BBB rating, whereas Alphabet, for example, has like a AA, and Amazon and Meta have a AA minus rating on their bonds. So, really just looking for more detail around how Oracle is going to be funding its AI ambitions. What's the return on this going to be? How is it going to compress cash flow in the near term?
All big questions, Laura. Thank you. Appreciate it. Coming up, we zero in on market-moving DC events investors should be watching in 2026. That's next on Market Domination Overtime. While 2025 may be coming to a close, the U.S. government is still having a robust to-do list of pending decisions, many of which are spilling over into the new year. So which ones should investors keep a close eye on? Well, here to discuss, we've got Henrietta Treyz, Veda Partners, Director of Economic Policy. Henrietta, always good to see you. So let's start on what you call, Henrietta, your most controversial call. That seems like a good place. Why are you assigning, Henrietta, 65% odds now that the Supreme Court does strike down the Trump tariffs? What is sort of the core legal reasoning you see here?
It's got to be Article 1, Section 8 of the Constitution. We fought the Revolutionary War over it. If you're going to tax Americans, certainly to the tune of $3 trillion over a decade, which is what CBO estimates the president's IEEPA tariffs are going to bring in, then that has to start with Congress. And so the oral arguments that happened in the Supreme Court a couple of weeks ago were 3 hours of basically circling around that debate. Is a tariff a tax? And the reality is that the Court of International Trade and the Federal Circuit Court of Appeals both found that these are, in fact, taxes, and they need to be enacted by Congress. The president is, not a king. He doesn't have the authority to do that. Exactly why we fought the British. So that's the crux of it. I think I'm in pretty good standing amongst my peers and thinking that the Supreme Court is going to side with the other two lower courts. That's not really the super controversial part of my call. I think the most controversial part is that I don't think the president has the leeway to reinstate these tariffs through other means in what would otherwise be basically Liberation Day 2.0. We saw the market tank that day. Businesses struggle for 6 months to adapt to tariff uncertainty. We're basically asking the president to do all that all over again in an election year, which is going to be where he would be doing it, January, February of next year. And I think that's a bridge too far. I think the U.S. consumers too concerned with affordability. Inflation's still hot at 3%. The Fed hasn't been able to get it down. Unemployment is up. I don't think that we're in a place that we were when the president, had a mandate fresh off of the election in April of 2025.
So, Henrietta, let's say you're right about the Supreme Court. When do you think, Henrietta, that decision could come? What do you think a timeline could look like?
Man, that's the key question. I mean, it could come as early as tomorrow. Any time in the next couple of days, the next 10 days, I would say, please don't take a vacation if you're an investor right now. This is a once in a lifetime binary event on, again, $3 trillion worth of stuff. So the possibility of the Supreme Court ruling this month is obviously very top of mind for the president. He was sending out social media posts about these tariffs in the Supreme Court case at 3 o'clock this morning. Jameson Greer, the USTR, expects that it'll come in December. So I can't say that there's any sort of read through to the black box that is the Supreme Court, but this is an emergency case. Both the Court of International Trade and the Court of Appeals decided their two cases from start to finish within 35 days. So that points to a sort of before year end, maybe even before the end of next week, announcements from the Supreme Court. It could take longer, but the next 10 days are, not to be taken a vacation.
Henrietta, I'm curious how you think the markets might respond and react if the court did step in and say, yes, the Trump tariffs are illegal.
It's going to be different for two sides of the market. The bond market is not going to like it. The bond market's been counting on that $3 trillion in revenue since the One Big Beautiful Bill passed. That was a substantially deficit increasing tax bill. Our deficit is at $38 trillion. Bond markets are very focused on that revenue, and they like it. The equities markets are a horse of a different color. If you are a Nike, Under Armour, Walmart, Target, Home Depot, you're going to be stoked to see these tariffs come off, and especially if they stay off. So it's really going to be differentiated. And I think that it's important for investors to get very nuanced and understand that there's a difference between China and India and, say, Japan and the UK. If we take reciprocal tariffs off as a available tool, my expectation is that the president will not reinstate tariffs on Japan or the UK or even South Korea the way that they are right now, even in some of the tacit agreements that they have. But China already has an existing Section 301 authority where you can quickly just replace the IEEPA tariffs with an authority that you already have and just hike the rate. There's a lot of countries to go through. Brazil, obviously, would be huge. Canada, Mexico. The list is long. All of Southeast Asia, Vietnam, the Philippines. So you really got to get granular. But it's going to be different for each type of tariff and each type of market.
Switching gears, Henrietta, I thought this was interesting as well. On ACA subsidies, your odds of extension fell. They went from 65%. Now they're at 25%. What changed there?
Yeah, we really were expecting for leadership to step in and say that in the economy where healthcare costs and housing costs are driving this narrative around affordability and really hampering the Republican conference, as we saw for the last couple of major elections in New Jersey, Virginia, and more recently in Tennessee, you could very easily pass, a 1 year, 2 year extension of ACA subsidies, and it's not an insignificant hit. For individuals over the age of 60, this is $920 per year. About 4 million people are going to be kicked off of healthcare exchanges. 22 million people would be impacted. So as you go into an election year, it's pretty routine for members to just throw money at the problem and offer short-term can kicks. But what we've seen from the leadership in the last couple of weeks since the government reopened is just a complete lack of unifying around a bipartisan consensus. And that was unexpected, again, given that affordability narrative and the fact that 2026 is a midterm election cycle. So now that we're unlikely to see the ACA subsidies extended, the odds of a government shutdown happening next year also rise just slightly from 20%, which is very high for me to start off with, to 25%, which would start on February 1st. So a lot of interplay for the first quarter of next year, and DC is going to be in a crunch.
Finally, Henry, President Trump is scheduled to speak here shortly, a couple hours. I'm curious, that this issue of affordability and economic anxiety, now a key political issue, and I'm just curious to get your take on how Trump is tackling that issue. What do you make of his tactics, his strategy, his game plan there?
Yeah, one of the hardest things that the president has to do in an election cycle is try to pass legislation. And as we started off by saying, he doesn't have the power to spend money. So he can't just issue a $2,000 tariff rebate check. He has to go through Congress. So one of the easiest things that the president could do would be to, let the Supreme Court take these tariffs off. It's an $1,800 per household benefit if you take the tariffs off annually. So that is something that the president could do, but it otherwise has to all be through executive action. Getting another big partisan bill through Congress next year is going to be a bridge too far. My odds are, at the highest 30% that the Republican conference will be able to do that, especially when you see about 24 Republicans on the House side retiring instead of running again. So the president is between a rock and a hard place on this. And I think the Supreme Court would be giving him a big out if they said, hey, you just can't put these tariffs on anymore. That would immediately alleviate, the price pressures that consumers are seeing at the grocery store over beef or, fertilizer costs for farmers or coffee even, so it's a pretty easy solution if the president wants to take it. And the Supreme Court could give him a gift by giving him a way out here.
Henry, always great to see you and to have you on the show. Thank you.
Thanks for having me.
Time now for what to watch Wednesday, December 10th. Going to start off on the Federal Reserve, a critical moment for the Fed coming up with December's FOMC meeting. Interest rate decision coming on Wednesday at 2 p.m. Eastern. Wall Street largely expecting the Fed to cut rates by 25 basis points at the meeting. Investors will be listening closely to Fed Chair Jerome Powell's commentary about monetary policy going forward. Jay Powell will be giving his typical press conference after the decision. Yahoo Finance will begin coverage on Wednesday at 2 p.m. Eastern. Taking a look at earnings as well, we're going to be getting another batch of earnings on Wednesday, including Oracle and Adobe. Oracle announcing results for the second quarter after the markets closed, and stock getting whacked over the past few months, down more than 8%. But analysts are expecting Oracle to be set up for another strong quarter because demand for its AI cloud is still much bigger than its available capacity. And the cloud infrastructure business could grow around 70% this quarter as more AI capacity does come online. Oracle should see strong near-term demand even before that big OpenAI contract ramps up over the next 2 to 3 years. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend, and I've got you covered for the next half hour with the latest and greatest market boom stories. Stay tuned.